Here's an area where inflation may start affecting insurance premiums kind of as a domino effect. So this is an article from the Wall Street Journal where inflation on vehicle and auto policies could start to kick in for premiums, meaning that insurance costs are starting to rise, partially because U.S. is returning to normal, but partially because there's higher cost in paying claims. Let's say if you have an auto claim, well, insurance claims dictate the premiums, and if insurance companies have to pay more for rental cars, which are in short supply and higher price, more for labor at body shops, maybe even replacement vehicles because the used car market has gone up and new cars are in short supply, the insurance claim may be higher for an auto claim. Same with homeowners. If you have a damage to your property, because of lumber prices have increased, labor prices have increased, the cost of that claim may be higher. So the insurers have to factor that into premiums to maintain viable business and sound financial retention. The question for insurers is to whether premium increases will be big enough, part of the cost of covering claim to repair or replace the cars under pressure. Global chip shortage, scarcity of rental cars, and increased price of lumber, meaning that especially for property and casualty, which is home, auto, those types of things, the inflation is hitting that area much harder. It's unclear how quickly people will return to their old driving habits, and what will that do to accident frequency. Certainly, there won't be as much driving. More people work from home, even part-time. But the cost for an actual claim is going to be much, much higher. Long-standing trends that could come to the forefront for insurers is long-term challenges for severity of losses for commercial auto, more sophisticated technology within vehicles that makes repairs and replacement more costly. Insurance have been trying to keep up with other types of inflation called social inflation, meaning higher jury awards. Think about the social mood of the market right now, of what people think a damage causes in terms of pain and suffering, in terms of losses, in terms of financial consequences to a family or a person. Jury awards could be higher, right? If you had to guess if they're going to be higher or lower than 5 years ago, I think most people would say it would be higher because most people feel like a loss is more of a catastrophic event. For some types of policies, such as home, sustained inflation can be priced into renewal terms. There are, however, businesses for which premiums collected today have to cover years of future claims. If wage inflation occurs, commercial policies such as work comp could be through the roof. The fact that labor markets are in turmoil, real estate markets are in high demand, and the vehicle supply chain is something that's never been before, this is going to affect insurance claims and then by extension premiums for many years to come. The hard part for insurers is figuring out actually what to predict for the coming years. Like the article said, for homeowners or auto, for personal lines, it's a little simpler, where on commercial lines, there may be longer tail events that could really need repricing in the market today to compensate for potential losses and risks for many, many years to come, something the insurance companies may not know about. So it's a little bit of a guess, and insurance companies have to really maintain solvency, so they're going to have to do their best to figure out what that best guess would be, but at the same time not throwing premiums out of whack to make their sales less competitive.